you can tell whatever story you want to tell depending on the data that you include or not include. And so, we'd have people saying, well, if you just take out used cars and eggs and specific things, then it's not so bad. And then the next month the basket of goods that you include in that changes. We're now talking, you hear tell of super core inflation that is even more niche than core inflation, which takes out energy and food prices. Could you talk a little bit about what super core is, why people are talking about it now, and why you think it might not necessarily be the best indicator of what's going forward?
The big thing for me is that you can think of inflation as micro. Here are 15 different markets, and let's tell a story for each one. Or you can think of inflation as macro, which is people are going to spend a certain amount, the economy is going to make a certain amount. We don't know exactly where the inflation is going to show up, but if it doesn't show up in eggs, it'll show up in, bacon or something like that. So that to me is the broad economics of it. Supercore subtracts used cars and subtracts housing, in addition to subtracting food and energy. I don't mind that. I think there's a certain logic. I publish that number every month. Look at that, on Twitter. I look at that number every month. So I think that's a fine number to look at, especially right now when the housing data we're seeing is actually lagged, and it's telling us more about past rent increases than current rent increases. But super core is not telling that different a story from core. Both of them have come down from their highs, and both of them are well above the Fed's 2% target. And both of those statements are true. Things are less bad, but things are very far from where they're supposed to be.
Right. And before we move on to kind of the labor market aspect of this conversation, which I think is arguably the most important one now, as you mentioned, when inflation first started to pick up a year and a half ago, whatever it was, a lot of people, including Federal Reserve members, were talking about transitory, that this was kind of a short-term blip, that supply chains were messed up by COVID, and once those unsnarl, things will start to return to normal. Is this timeline that we're on, that there's a bank that was estimating inflation will be back down to 2% by the end of this year? Things are starting to drop now. Is this within the bucket of transitory? Is this what those people were talking about? Or kind of how do you see the timeline that we've seen over the past couple months here?
Yeah, I mean, the problem is that a lot of the transitory narrative was things like unusually high goods price growth will fall. And we've seen that. The transitory narrative has happened, but other things have moved in the other direction. So goods price growth fell, but service price growth grew, and services have 3 times the weight in the consumption basket as goods. And that's just another good example of why you want to think about the macro, think about it as a whole, because if something goes right in one area and gets undone by another area, it basically doesn't count. So we've seen a lot of the transitory stuff materialize. Now, the question is, will service prices start to slow? Right now, they're moving unusually high. Some of them, like the cost of housing, rent, likely will slow. But a lot of other ones are very dependent on the main input, which is labor, and their main cost is wages. And so you have to look at the labor market to understand, where the bulk of inflation is coming from and where it's likely to go.